Hello, and welcome to Reflections on Investing with the Cornell Capital Group. Today we're diving into one of the biggest revolutions reshaping financial markets, the meteoric rise of passive investing. In the next few minutes, we'll uncover how tidal waves of cash flowing into index funds are changing stock prices, and what this means for investors, markets, and risk premiums. So let's start with the numbers. In 2015, passive investment funds managed around $200 billion. Fast forward to 2025, and that number is closing in on $1 trillion per year in new inflows. In a single 12-month period ending March 2025, passive funds attracted $882 billion, while active funds saw $194 leave. So this active to passive flow gap, the largest ever, signals a fundamental shift in how capital is allocated. So what's driving this phenomenon? Well, lower fees, widespread adoption in retirement plans, and frustration with active manager performance. And the biggest effect has been on the market's largest companies. Some studies show that since the late 1990s, the 50 largest U.S. firms rose 30% more than the broader market, thanks in part to passive buying pressure. Market concentration has now hit historic highs. The top 10 companies now account for 39% of U.S. market value, more than double their share a decade ago. Maybe the biggest consequence? And this deals with something we've talked a lot about in our Reflections on Investing series, and that is the equity risk premium, the return investors expect over safe bonds. And that has nearly vanished. One measure shows in 2000 the risk premium was 6.5%, and now it's just 0.2%. And there are a few different ways you can calculate the equity risk premium, but regardless of which measure you use, they've all come down a lot and are at historic lows. But why does this happen? Well, passive funds like the S&P 500 use cap-weighted strategies. The biggest companies get the biggest inflows, regardless of their actual fundamental value. And this can create a feedback loop. Bigger companies get more investment and keep getting bigger, even if the fundamentals don't justify it. With more than half of the market now passively managed, price discovery fades, meaning fewer investors are trying to find cheap stocks or question expensive ones. They're just buying the index. So what does this all mean? The passive revolution has made markets more accessible, but also more concentrated and potentially more fragile. With 60 to 70% passive market share on the horizon, the future could bring new opportunities and new risks. For example, what if there is a financial crisis or just a change in sentiment and passive investors want to sell to access their liquidity? Who will be on the other side of the trade when they all attempt to sell? Presumably active investors who believe that valuations have melted up to excessive levels will not be willing to buy until prices have declined substantially. Thus, while the melt-up may occur gradually, the reversal could be sharp and swift. That is one of the risks investors face today. So thanks for joining. This has been Reflections on Investing with the Cornell Capital Group. For more info, please visit our website at cornell-capital.com.